Hello, everyone. It is time for a tariff crash trading plan. I will be getting to that in a few minutes. I need to, of course, set up the context. Today was the day that the president announced the tariffs, lots of impacts. Unfortunately, a lot of the charts that I show really are just going to be total history, but they still are good context for the plan that I'm going to discuss later on in this video. And mind you, that there are just multiple scenarios that could play out. So I'm not making any predictions, not making any recommendations. Please do your own homework and trade and invest according to your own risk tolerances and time frames. All right, let's move on. So this is CNBC. As you can see, the futures are all down significantly. Even oil is down 2.4%. Um, when I was looking at after hours trading, I know the S&P was down as much as 3%. Just total crash level. When I say crash, I don't mean like a 10% drop, but just such a sudden and abrupt drop. Now, what surprises me the most about these drops is that it tells me that the market for some reason persists in not taking President Trump's tariff plan seriously. So what do I mean by that? Well, I wrote about and talked about what I hoped was a capitulation day on Monday when the market gapped down and then rallied to a gain. And it was followed by another day of buying, and we gapped down today, and buyers ran up again. And in fact, I think when the news was announced after market, but I think the market actually started rallying some more at the beginning of the tariff announcement before everything just fell apart. So this part concerns me because I always defer to the price action of the market for my information. And what I'm seeing now is that what I thought was a process of the market getting used to this bad news of tariffs was really more about the market reluctantly trying to grope around for how to price in this coming bad news. This is important because number one, it means that we can't trust the market totally to understand what's going on, and that is in itself understandable because things have changed so much. There's so much uncertainty that's in policy. Policy could change on a dime. It's one thing today, it's another thing tomorrow. Now we're going to have to deal with retaliations from other countries. Some countries will negotiate. Negotiation news will go up and down and back and forth. So yes, a lot of craziness ahead. So that's why everybody, whether you're a trader or investor, has to have a plan, and that plan has to start with do not panic. Okay. So anyway, and I'll talk about how you could try to prevent yourself from panicking. Essentially, the time to sell was earlier, like say at this 200-day moving average. The time to sell is not when the market is deeply oversold. And of course, I have to be very clear. I'm talking about the major indices. Now, sometimes weak businesses, it's always a good time to sell, down, up, whatever, because some of these stocks, some of these businesses are not going to survive through this period, and or they will not come out the other side better. So there are individual stocks, of course, and that you're going to have to determine for yourself. But when I say it's too late to sell and you can't sell in a panic and don't sell in oversold conditions, I'm really mostly talking about the indices. Okay, so why is there so much uncertainty? Well, let's just scroll down and look at the headlines on CNBC and just take a look, right? Um, Look at this, look at the terminology here. Shock, tariffs shock US trade partners. Really? They shocked the US trade partners? Hasn't this stuff been telegraphed enough for months on months and months, maybe even a year since the presidential campaign started? I mean, maybe some of these numbers people weren't quite anticipating, but the word shock tells me that, people just haven't been taking this risk seriously. So there's more than 180 countries and territories facing these reciprocal tariffs. Vietnam has a massive tariff hit, and that could hit Nike, which of course has a lot of manufacturing in Vietnam. Here's an interesting title, headline: Treasury Secretary Bessent says that market woes are about tech stock sell-off, more about sell-off, stock sell-off than Trump's tariffs. That's pretty fascinating because I guarantee you tomorrow morning there are going to be plenty of damage outside of tech, and I'll show some other likely um, victims. And then this is my best headline of all. And unfortunately, I can't read this article, so I'm not CNBC Pro. Trump's new tariffs are worse than the worst case scenario. Now, if that doesn't tell you being unprepared, I don't know what else could to say it. So there's also a group of analysts out there who also were either spinning a lot of positives out of this tariff narrative and or have been reluctantly been dragged by these headlines hoping and hoping for negotiations, or maybe Trump wasn't all that serious, or maybe he changed his mind, whatever it is that didn't allow people to really think hard about how bad this could be. Okay, and then I wanted to just do another snapshot here for on Yahoo Finance. Just look at some of the headlines. Again, this is all context setting. Um, Slaps, here we go with the picture, choice pose, of course. Now look at what the headlines are saying. Again, these headlines, if you really dive deep into these stories, could cause panic. The move could upend global trade and represents the climax of Trump's focus on what he sees as the US getting ripped off. Is it really the climax? We don't really know. It's definitely a big moment, but who knows whether it's the climax? There's still more to come, in my opinion. Stock futures plunge as Trump's punishing tariffs rip through the markets. Here's one that I'm probably going to read soon. We now know the full extent of the Trump tariff tax hikes. Do we? Do we really? I mean, there's a lot of stuff out there, of course, but if there's retaliation, the US has promised to retaliate back. So this may not be the end of the story. And so we all need to be prepared for that. We need to be prepared for tariff headlines just dominating the news for weeks, maybe months on end. It would be great if it didn't, but you just have to be prepared. Here's China, of course, demanding an immediate lift. Um, Volkswagen to introduce import fee on tariff hit cars. That's going to be something that's going to hit the pocketbook of Volkswagen buyers immediately. Here's France's response. Here's an article about the reactions from across the globe. So, we get a sense. Oh, here's the EU plans countermeasures to new tariffs. I'm surprised the Canadian headline is not here. Canada is getting ready to go. I haven't seen what Mexico's planning to do. Um, so anyway, if you dive too much deep into this stuff, it could cause panic. And again, I'm trying to promote let's not panic in the short term. Yeah, this is going to be very painful. So that you have to have a plan for how to get through moments like these. Okay. So I talked about my disappointment in the market signal from the S&P 500. The place where I really did see, and this is, I guess, what Besson is talking about, is that the NASDAQ has been limping along much worse than the S&P 500. And I laid out a worst case scenario, the NASDAQ hitting 16,000. If we get open like I think we're going to get open and some follow through selling, I think we could get to 16,000 in short order. Um, and again, I'm not saying that to create panic. This is just mapping out what are the potential scenarios. And hopefully you've risk managed properly to this point, such that you could actually maybe even look forward to buying some cheap stocks if the NASDAQ does indeed get down to this level. And then on the small caps, IWM or iShares Russell 2000 ETF, I really took heart in this move here. This was essentially a bullish engulfing move. It's kind of hard to see because of the volume bars, but anyway, I've talked about bullish engulfing before. I won't talk about it again here, but this looked like a true confirmation of a bottom. I talked about in my last video that I bought IWM calls here because I'm always buying when the IWM makes an extreme move, and so I took profits on them into this move. In fact, I took profits on a lot of short-term trading moves going into the close today, and that was because one, I was very uncomfortable with this notion that the market was rallying into what should be bad news. The way it's supposed to work is that the market is supposed to stay worried about bad news, either sell off into the news or at least don't do anything. And then when the news comes out, suddenly some amount of certainty comes into play, and then the market rallies, or even maybe the news isn't as bad as everyone feared. But unfortunately, we've got the reverse going on here. Okay. Even my favorite technical indicator, The percentage of stocks trading above their 50-day moving averages was looking pretty positive with a strong, strong, strong follow through day today. Of course, that was mostly driven by the small caps. So now this is where I'm going to start talking about at least my tariff crash trading plan. First of all, what I'm hoping for is that we finally get to official oversold levels. That's 20% or below. Because once we get to that level, I can kick in what I call my AT50. AT50 stands for above the 50 day moving average. And I can kick in my AT50 trading rules. And what are those rules? Well, you can go to my blog at drduru.com/122. And then at the top, actually, let me just pull it. I guess I could pull it up here and show you. This is my blog where I write in more details, and you can see up here, right here under market breadth is where I put my trading rules. Okay, so I'll just leave this up so you can get a visual as to the headline. Anyway, like I was saying, I'm segueing over to the trading rules because if finally we get to this oversold level and hopefully below, my trading rules, number one, state that once I'm there, I can get aggressively bullish on the market. Now, this isn't bullish. Um, sorry, this is just bullish for the short term. So I need to be very clear because let's go back to the S&P 500. Um, and this is going to be an important definition for a while is that ever since we broke down below this 200-day moving average, I have considered the market in a bear market. Um, and I know that's not conventional. The conventional definition is 20% below the all-time highs, but that just is not a fast enough signal because by the time the market gets to a bear market, it's pretty much done most of its selling, if not all of its selling. So, the official definition of a bear market is ironically almost like a buy signal. And so I'm being very cautious to say that even though my favorite technical indicator hopefully drops into official oversold territory tomorrow, my aggressive bullish call is only in the short term, but also within the context of a larger bear market. What does that mean? It means that I'm playing for a bounce, some kind of bounce where I want to buy low and then sell the next rally. That's as simple as it gets. And the timing is always tricky. It's been tricky even coming to this point because, like I said, the market has surprisingly been reluctant to price in the worst of the possible news. But now we're finally getting there. Now, there's a second component to the AT50 trading rules, which is the VIX, the volatility index. And in my previous video, I mentioned how I was disappointed that on the capitulation day on Monday, and again, look at my previous video or you can go to my blog to read about this, the VIX did not spike all the way to the previous high. So that was the one thing, that was the main signal that kind of undermined the capitulation Monday, as I called it. It undermined, sorry, the robustness of the capitulation. What I wanted to see was the VIX go up here because that meant we really are flushing out a lot of fear. So instead, now what we're probably going to get is the VIX gapping up at least to this high and probably higher because fear should really be at an extreme tomorrow morning, which will be Thursday, April 3rd. And if the VIX doesn't even reach this point, then again, I'm going to have to be kind of doubtful that we've gotten true capitulation. So AT50 trading rules say if we get an oversold reading and the VIX rallies to a previous high, it's time to start some whatever buying plan I'm going to put together. I have to think about it tonight and tomorrow morning. And note, I hope to be just doing a lot of watching tomorrow morning and not trading because I expect tomorrow to be extremely crazy. But anyway, like I was saying, so oversold conditions and a VIX spiking extremely high. So, in the ideal case, what might get me buying right away is say the VIX really goes nuts and like gets to the high that it reached last year, August. Okay, that's just an obvious buying signal. Well, I shouldn't say obvious, nothing's obvious, but it's just a very strong one for my taste. Now, if the VIX say gets to 35 or 39, it is a good buying signal in my book and with my trading rules. But at that point, I want to see what happens after that. I want to see the plunge. So, for instance, back here in August, once the VIX went into this plunge, that was all I needed to see for the buying signal. Similarly, in December, we had that big spike and then the VIX plunged the very next day. that was a buying signal that lasted at least for another week or so, I think it was. Well, I mean, some things went all the way to the beginning of the year. So hopefully that made sense. If you have any questions, of course, put them in the below or any feedback. I'll be happy to answer those questions. You may be watching this video in the middle of market trading and it's already crazy. If you've made it this far, good for you. And now I just want to end on some other things that surprised me about the way that the market failed to truly signal. Um, for instance, Apple, huge business in China. Yeah, sure, it was underperforming, but look, it bounced and it was actually starting to outperform the NASDAQ in the last week or so. And I saw in the after hours that Apple gapped down like 7% or something. So that tells me that Apple investors and traders weren't taking the China risk seriously. Okay, that was surprising. Now, Dollar Tree, I mentioned in a previous article, and I think, yeah, in a previous article that I thought that the discount retailers were starting to turn the corner. And if I scroll back here, of course, this could be turning the corner in the intermediate term and not, an absolute bottom. But here's Dollar Tree, nice consolidate. Well, not nice consolidate, pretty wide range, but it's consolidating here. It's right below the 200-day moving average. It survived earnings with a massive 11.2% pop. So things look like they're turning around. Dollar General is even more convincing. And I actually did trade this, and I took profits today because Dollar General hit right at the 200-day moving average. But I also saw Dollar General dropped about 6%. What were people thinking then, having rallying into this tariff news? Clearly, there were a lot of people, or sufficient people, who were expecting that the worst was already behind us, and that just wasn't the case. So very surprising. Now let's take a look at some of the industrials. And this is just to show that this sell-off is not just about high tech stocks. So Caterpillar again rallied into the close today, but I saw it gap down about 5 or 6% in the after hours on the tariff news. Amazon was another one I thought would look very good, and it had a nice bounce, 2%. Now, there is some news about the de minimis rule for that was allowing Temu and other cheap Chinese retailers to get around some tariff or importing rules or exporting rules. So maybe that helps Amazon a little bit. Maybe it'll help like an Etsy. Let's see, how is Etsy doing actually? Yeah, look at that. Etsy rallied into the news. So there is a small possibility that, stocks like Etsy and Amazon will be high on my buying list if they pull back. Now, I'm already a holder of Amazon. Um, and so actually I may add a call option, sorry, call spread instead of buying shares. And so that's another part of the trading plan I want to discuss is that um, because it's going to be hard to tell when the final bottom is in or a likely bottom, yeah, I'm going to be managing risk very carefully. So, number one is if I buy any shares, it'll be very small amounts and it'll be with a plan of buying at an even lower price. The only good thing after tomorrow's presumed crash is that the lower the market goes, the more attractive it will get to buy. I know that sounds counterintuitive, but this is why I'm saying don't panic. You have to think about this as a big, big store where everything's going on sale. Jim Cramer had a joke that he said that the our current economic policy is, or the stock. This is the Walmart stock market. Every day, lower, lower prices. I haven't listened to Kramer in a while, but I checked him out today just because I just wanted to see what his commentary was on tariffs. Anyway, what I wanted to say is, okay, so small amount of shares, be prepared to buy at lower prices. And that first buy has to be in something that that I'm convicted in and that I don't mind holding through all the whatever churn and chaos is to come. Secondarily, if I do options, I only want to do spreads. And why do I want to do spreads? Because premiums are going to be extremely high. And so it's very possible to buy, say, even a call option at or near a bottom, have the stock rally just as you expect, but be slow enough such that you don't gain anything and maybe even lose because the implied volatility implodes. I've had this happen to me before. It was a hard lesson to learn. So now if I buy in the middle of if I buy options in the middle of a volatility spike, I only do spreads because that reduces the net volatility premium that I'm paying for. And that could be vertical spreads, that could be calendar spreads, and the diagonal spreads. Any one of them, any one of those varieties will reduce the volatility premium that you pay. Okay, so I think I've covered everything. There's going to be a lot to discuss in the coming days, of course. I'm going to do my best to put out another video after the close of trading Thursday because I suspect we'll have a much more accurate picture of what the market is going to be looking like in this new period. Oh, and one other thing I want to say about sort of the economic world that we're in is that whenever you hear people making predictions about how the policy, whether it's the supporters of this chaotic economic policy or it's the detractors, know that I'm kind of leaning towards the detractors. And this is because I've written about this in my blog before, is that we went into this year with the economy running about as good as we can expect. And so that any changes had a lot of downside risk to the economy. Um, and these changes that are happening are massive changes. And so that means that it's even dangerous to pull out charts from history and say, well, because XYZ happened, well, I'm going to pattern match and assume that XYZ or something similar is going to happen now. Literally, the global economy is being restructured right before our eyes, and we don't know how to respond to that. And what I mean is like think about it this way. Let's take a look at the S&P 500 on a long-term basis. And sorry, there's going to be a bunch of writing in here, but think about what, this is very impressive. And actually, these markers are here for a blog post that I'm writing about how to do no regret selling. But this is an impressive rally. But let's have two perspectives here. Is that one? This was one kind of world, particularly after World War II. There was a particular global order that helped support this essential um, overall uptrend that people have relied upon so much that, now so many people, I mean, you don't have to look far on YouTube or social media. So many people treat the stock market like it's a savings account. Just put money in either on a regular basis or buy every dip, and you're going to be just fine in due time. But that's under a particular global order where things were oriented a certain way. And so we have to start thinking about has the current policy are the current policies changing things dramatically enough that the previous assumptions that we had are being turned on their head and must be questioned. The second thing I want to point out, and again, I'm going to write more about this in a blog soon, is that we forget that even though this is a nice, impressive uptrend, we have had long stretches where the market has gone nowhere and then sprinted in between. So I marked off, like, for instance, here, this is the famous go nowhere period where it was from the essentially the mid 60s to all the way till the 1982 where so it was almost 20 years where well I marked off 19 years where the stock market on net went nowhere. Of course, if you bought here and sold and held till here, it looked like, a nice uptrend, but overall it held into this box. And then we had this nice sprint into the dot-com bubble. And then you look at this box that I was able to draw here from this low to the entry of that box. And that's what I did here. I put the lower end of this box at the low of this period and then drew it all the way back until I hit the next price point. So this is essentially, going nowhere for sure. But anyway, and so look at this box, 17 years of churn. Now, this was a much wider churn, I think, than this one on a percentage basis. And what we're in now is a 12 years and counting run. I mean, sorry for all these lines here, you can't see it, but even if I put in the pandemic dip, the pandemic kind of almost looks like noise, like insignificant, like a pinprick compared to this just nonstop buying and nonstop uptrend that we've had in the market. And this has been going on for 12 years. Now, again, I'm not going to map to history. I can't say, oh, well, we've got hopefully we have another 2 years, or we are 4 years overdue for going nowhere. No, there's no specific pattern here. I'm just saying that it's not unusual for the stock market to get stuck for many years in time. So think about this. If the global economy is being completely restructured and reordered right before our eyes, it could take the stock market some time to get used to this new order. And it may take some time to get the pricing and valuations in line with the new risk that this new order will have. Who knows how many years that could take? So we could be entering another one of these extended periods. Now, the only thing I can say good about these extended periods is that my framework of trading on the extremes works best actually in these trading ranges. It doesn't work quite so well, particularly on the upside when we're in these uptrends. And what do I mean by valuation? Well, so many people have these different notions, but I'm going to just go to what some people use as the Shiller PE ratio. Now, people have been willing to pay up for stocks again because there's a certain particular economic order that people have been taking for granted. And now look at the premiums according to the Shiller PE ratio. Of course, there's all sorts of ways that people measure valuation, but this was one I found very curious is that we stopped just short of the crazy valuations we saw in the wake of the pandemic after the Fed had dropped interest rates back down to zero. And we stopped just short of the ultimate bubble back in 2000. So if we're stopping short of this valuation extreme, it means that we could be set for, again, for a market that's finally taking risks seriously and finally pricing in risk, we could be in for a time where the market gets back down to this level or maybe even lower levels, depending upon how much risk people assess. Now, because I'm not a valuation person, I'm not going to predict where this valuation is going to shake out. And there's just so many different valuation models. Who knows? This is just one perspective. And again, what I'm trying to paint out is these different scenarios that we have to be prepared for, not to panic, but just to be prepared um, in terms of what kinds of risks and things that we're taking. Okay. Oh, and while we're here, why don't I just take one quick look at crypto? Because this will tell me whether it's truly risk on or off. This is after market. So you can see that Bitcoin looked like it was getting ready to do this big breakout I've been looking for out of this wedge, and it reversed too. So it is kind of encouraging to see it's up as I speak, despite the futures being down. So we'll see which kind of risk sentiment takes over. But I'm going to be keeping an eye on crypto again as a good indicator of risk sentiment. So again, please share and like this video. It helps others find this content, of course. It helps me with the algorithm, helps me get more followers. And again, if you have any comments or questions or feedback, you can put them down below in the video. And you can please subscribe to this channel or check me out on the blog and you can subscribe there, where I will be, of course, taking this video and turning it into the next blog post. But most of the time, I'm posting independent of these videos. So anyway, hopefully this was helpful to you, and be careful out there. As I always say um, at the end of my blog posts, don't panic. I can't say it enough, but also be prepared. The whole world may be changing, and previous and past assumptions may no longer apply. But what will apply is price action and the technicals of extremes. So let's keep an eye out for that. Take care.